Welcome back. In the previous video, we covered how central the concept of co-wiggling is. If you want to reduce your portfolio risk, the kind of stock that you want to add to your portfolio is not necessarily the stock that has the lowest risk, but the stock that least co-wiggles with the rest of your portfolio. In this video, we'll discuss the best measure of co-wiggling. If investors are smart, what should their main portfolio resemble?
Please pause this video now, answer the question on a piece of paper, and then continue.
A very heavily diversified portfolio, something like the overall market, maybe the overall stock market, but a lot of other things perhaps in there as well. International assets, bonds, some real estate, education, your own education, a house, all kinds of different things. But the overall stock market is one of the more heavily diversified portfolios, so we're going to use mostly the stock market. Let's presume that A, in the example that we're working, is the overall market, and you are selling to smart investors holding, at this point, all of A, nothing but A, and you're thinking about selling to them either project C or project D. For which of these two projects do you think will your investors clamor to invest more in your project? Where will they require more rate of return? Where will they require less expected rate of return? Where will they pay a higher price, C or D?
Please pause this video now, answer the question on a piece of paper, and then continue.
More clamoring, of course, means that they accept a lower expected rate of return, which is the same as saying they pay a higher price. And we just worked through that D is better for diversification than C. Thus, somebody who holds A would pay a lot more for D than for C, effectively requiring a lower expected rate of return on D than on C. This is the fundamental insight of investments. Investors should care about overall portfolio risk, not about the constituent component risk. And from a corporate managerial perspective, it is not the low-risk projects that your investors want you to take. They want you to take projects which wiggle opposite to the rest of their portfolios, and the rest of their portfolios usually are something like the stock market. How should we measure synchronicity? Again, we consider A to be the market portfolio, and we now need a measure that tells us about C and about D, how synchronous they are with the market portfolio, which in this case is A. And when I say synchronous and how they co-wiggle, well, co-wiggle is not exactly a very technical term. We're going to use something like a covariance. Let's go back to what we had before. So our assets are in the upper table. Demeaned, they're in the lower table. Because when I want to compute the covariance, I have to work with demeaned assets. So the way this works is the covariance between A and B is A minus whatever the mean of A was, times B minus B of mean. And I've got 4 of this, so I actually need to divide it by 4. In this case, there's not much dividing by 4 because 0 divided by 4 is still 0. So I'm going to go back now. If I look at my previous slides, A and B seem to be uncorrelated. When A goes up, B is equally likely to go up or go down, and by the same amount, and vice versa. So A and B are uncorrelated. This is what the covariance just told me. So for the covariance between A and C, I have to work with the difference in the A's from their own mean and the difference in the C's from their own mean. I go back to it. The difference in the A's was minus 5. The difference in the C was 2.5. Multiply 5 by 2.5. The minus cancels, and you get 12.5. We've got 4 of these numbers. I have to divide by 4. That gives me the covariance. That turns out to be 6.25. And finally, the covariance between A and D is minus 25. This already gives us a hint. This is a very negative number. When A goes up, D on average goes down. This is our 4 assets. Now, if you're a nerd, you can organize these covariances into a covariance matrix, which just gives you on each one the covariance between these 2 items, and this is a symmetric matrix. This is actually sometimes useful when you do some other calculations. Now, correlation. You've already learned about correlation. Everybody knows a little bit about correlation. How do you calculate a correlation? The way you calculate a correlation is you take the covariance and you divide it by the square root of the standard deviations, which in this case is 0.707. There's another measure of how A and C move together, and that's called the beta. And the beta of C, M is the covariance between A and C divided by the variance of A. Well, in this case, it's M. So whatever the second index variable on the beta is, that's the thing that goes at the denominator of the beta. In this case, the beta of C with respect to M is 0.25. Why is it called a beta? Because if we're trying to fit the best fitting line slope to that, that turns out to be the best fitting line slope. You can also say this, that the market beta, or in this case, the A beta of C is 0.25. We're going to do that with D now. If you want, you can stop here for a moment and just calculate it yourself before I show it to you. Here is the same thing. The correlation of A and D is now negative. It's minus 0.707. And the beta of D with respect to the market now turns out to be minus 1. Covariance, correlation, and beta always have the same sign. They differ in magnitude and units. Here are the numbers we are most interested in. Remember, our question is, we hold A, the market, and we are considering adding C or D to our portfolio. The sign is the same for C and A, it's always positive. For D and A, it's always negative. The order of your input variables does not matter for covariance and correlation. It does matter for beta, however. Now, it's the best slope. I'm going to show it to you in a moment. It's the best slope where A or M is on the x-axis and the project, which in this case can be B or C or D, is going to be on the y-axis. A slope of 1 is a diagonal line. A slope of 0 is a horizontal line. And the slope of infinite is a vertical line. And what you want for diversification purposes is something that has less correlation with the market, which is the portfolio that you hold. So the more negative, the smaller, the more negative the beta is, the better it is for taking down your risk. Ideally, it would be minus infinite, but of course, it's never minus infinite. So here are the best fitting slopes for the 2 examples that we have. The market, A or M, is on the x-axis. C is on the y-axis in the left graph. D is on the y-axis in the right graph. And as you can see, the line is positive. The slope is 0.25. And the line is negative, minus 1 for D. So the market beta of C is 0.25. The market beta of D is minus 1. The covariance also generalizes the variance. And remember, for the variance, the units are completely uninterpretable. Nobody can make sense of this. So covariance is not going to be a great measure of how good for diversification it is. Now consider another security that I'm going to call E. And my E security is 100 times more wiggly than C. So by adding just a little bit, $1 of E, I'm adding a lot more contribution of risk than if I just added C to it. So if C co-wiggles a little, E co-wiggles a heck of a lot more. It's 100 times as risky. You can check this if you want. You can just calculate a portfolio, or you can trust me. Now, if you look at the covariance tells you indeed it is 100 times worse than C. The correlation does not. It turns out the correlation of E and A is the same as the correlation of C and A. So for our purposes, it has a scale problem. It's scale invariant. It hasn't changed, even though E is far riskier than C. The measure that does what we want is the market beta. It tells you that the market beta of E is 100 times bigger than the market beta of C, which is exactly what we want. It also has meaningful units and it's interpretable. So let's look at some more of the interpretation of this. The best measure of the risk contribution of adding a little bit of a particular security X to the market is X's market beta with respect to M. Well, market beta is always with respect to M. So with empirical data, that means in the denominator of the formula, the covariance divided by the variance of the rate of return on the market is always the denominator. Here's the formula. The beta of security I with respect to M is the covariance of Ri with Rm divided by the variance of the market. Beta tells you how an X% higher rate of return than normal on the market is likely to associate with a simultaneously higher or lower rate of return in your new particular asset, like C or D. The stock return beta also helps you with a conditional forecast of Ri, of your particular asset, if I tell you what the market is. So if I tell you that the market was 10%, the beta actually gives you an idea of what the rate of return on your security should be. So if it's a negative beta and the rate of return on the market was plus 10%, that means that the rate of return on your particular asset is less than you expected it to be. There are mediocre measures of market beta available on practically every finance website. A better estimator would be to use daily stock returns on 1 to 2 years of historical data. There are much better market beta measures, even than that. They shrink smartly, but don't use the ones that you get just from the websites if you care about beta. Incidentally, somewhere in my notes, somewhere in my book, I described that beta is also a hedge ratio. So what would you buy a particular asset if you want to neutralize the risk of the market? We're not using that here. Another thing that you must never do is do not use peer stocks betas if you do not have to. So if you are, say, IBM or Apple or any other tech firm, do not use the beta of tech firms in lieu of your own beta. That only makes your own beta estimate for the future worse. Let's figure out some more aspects about beta. What's the market beta of the overall stock market, say the S&P 500?
Please pause this video now, answer the question on a piece of paper, and then continue.
Has to be near 1.0, of course. Well, I'm just saying near because maybe you're using a different kind of stock market. But typically, when the market goes up by 1, whatever your market proxy is should go up by 1. And mathematically, if you use the S&P 500 also as your market index, that's got to be 1.0. What is the market beta of the risk-free rate?
Please pause this video now, answer the question on a piece of paper, and then continue.
That one has to be near 0, of course. Why? Because the risk-free rate is known. It's a number. It doesn't wiggle. It co-wiggles with nothing. Now, given an equal expected return, what's more desirable to an investor heavily loaded up on the stock market? A project with a high beta or a project with a low beta?
Please pause this video now, answer the question on a piece of paper, and then continue.
A project with a lower beta. Think of beta as a measure of toxicity. Beta is a measure of toxicity. You like stocks with more toxicity less. You like stocks with more beta less. So given the same expected rate of return, you would hold less of the stock with higher beta and more of the stock with lower beta. Should high or low variance projects have to offer higher expected rates of returns?
Please pause this video now, answer the question on a piece of paper, and then continue.
There's no necessary relationship. It depends on whether your investors can easily diversify away such variance, and because every given project is only a tiny, tiny amount in investors' portfolio, it doesn't really matter what it does by itself. So variance itself is unimportant. Should high or low market beta projects have to offer higher expected rates of return?
Please pause this video now, answer the question on a piece of paper, and then continue.
High beta projects should have to offer higher expected rate of return because they are more toxic. You don't like them as much. So to get you to buy more of them, they have to be sold at a lower price, which means higher expected rate of return. That means because we think that most investors hold something similar to the market, most investors are going to want stocks with lower beta. So if you as a manager can offer them a project that has a lower beta, they're going to like it much better. Now, there's another very neat aspect about market beta. Let's presume I'm thinking about buying another firm and I'm going to turn into a conglomerate. And so my conglomerate is going to be 40% of C and 60% of D. Say C was worth 4 million, D was worth 6 million, and I combine the two. What is the average rate of return? What is the average variance? What is the average standard deviation? And what is the average beta? You can calculate all of these. We have done this before. Now, you can value average, means, and betas. You cannot value averages, variances, and standard deviations. So, for example, in this case, recall that the beta of C was 0.25 and the beta of D was -1. So, is there a quicker way to compute the market beta?
Please pause this video now, answer the question on a piece of paper, and then continue.
Yes. Just calculate the value-weighted average, 40% of 0.25, 60% of -1. Your conglomerate is going to have a market beta of -0.5. There's something called a mean variance efficient frontier. That is, if I give you many, many different assets and I ask you, can you form the optimal portfolio for me that has the optimal weights trading off all the expected rates of returns and all the covariances, how would you do that? And this is the method by which you would do it. It would generate a mean variance frontier of all the portfolios that you might ever want to choose. That underlies the models that we do later, but just trust me that this is the case. If we wanted to cover this, it would require 2 or more full lectures and a lot of mathematics. And for our purposes in a corporate finance class, it's not as important as it is in an investments class. The rest of this video is going to cover a variety of topics that are related, but not the same. The most important relates to how risk grows when asset returns are uncorrelated. I'm going to start with the formula for the rate of return on a portfolio. The rate of return on a portfolio is WA, whatever you invest in the first part, times RA, plus WB times RB. And the variance of that is equivalent to this variance formula. It's basically W squared of A times variance of RA plus WB squared times variance of RB plus 2 times WA WB times the covariance RA RB. This last term, 2WA WB times the covariance between the two of them, is why the covariance is not the weighted average. This is where all this diversification and other stuff comes from. This is why you cannot value weight the same way that you can do with beta and expected rates of returns. There's also a generalized variance formula if you're a real nerd and you want to figure this one out. It's a double summation signs with WIs, WJs all over. Sometimes it makes it easier to change portfolio weights. It's really important if you want to calculate the efficient frontier. Since we are not doing this in this class, I spare that for you. Now, I want to look at a context where all this gratuitous algebra is actually very useful. Here it is. What should be the expected correlation of one stock's rate of return from one day to the next day?
Please pause this video now, answer the question on a piece of paper, and then continue.
It's got to be about 0. Otherwise, you would only buy after a stock has gone up and sell only after it has gone down. And if you do this many, many times, you would get richer than a buy and hold investor. So it's got to be that whatever you make today in the stock market is not telling you much about what you're going to get tomorrow. In an imperfect capital market, could this expected correlation be a little bit off from 0?
Please pause this video now, answer the question on a piece of paper, and then continue.
Yes, just a little bit, as high as the transaction costs are, but not by very much. In a perfect capital market, can the actual realized correlation be a little bit off from 0?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, not if you have an infinite sample, because in an infinite sample, then you get the true expected correlation, and that we already know is about 0. But if you have a limited sample, say only 2 or 3 years, then it can be off by quite a lot due to sampling error. But this is an example where history is not indicative of the future. We would not expect that to continue in the future. And here's our application. We want to annualize risk. So the important question that we want to ask is, if the risk of investing in some security X for 1 year is 20%, then what is the risk of investing in X for 10 years? Here's the first assumption. We know that rates of return over time should be uncorrelated over time. We just did this. It's a consequence of perfect market and the fact that you cannot easily get rich. It's got to be very, very small. Here's assumption number 2, and that's really more for convenience. It doesn't have to be. We're going to assume that the per unit of time standard deviation remains constant. If not, we sort of would be working with an average risk. I'll spare this to you. Make this just easier for illustrations. Now, because we have constant risk, whatever I use as my sigma doesn't have to have a time subscript. But in this case, my variance of my portfolio from time 0 to time t is going to be the variance of, well, the summation of the individual returns plus many, many small cross terms, which we did in the first video of this class. But since a return is typically about, I don't know, on an individual day, about 1%, each cross term is about 0.01 times 0.01. So it's almost nothing. All these small cross terms don't account for very much. Therefore, I know that the variance from time 0 to times t is primarily the variance of whatever the variance is on the individual days. Now I have to use my variance formula. My variance formula says, well, this is the variance of the first plus the variance of the second plus the variance all the way to the last one, plus many of the 2 times W1 times W2 times the covariance, blah, blah, blah. But we've just figured out the covariances should all be about 0. So now that the variances are going away, all that I have left with is t variance terms. And because each variance is the same sigma, I know that the variance of the portfolio from time 0 to time t is t times the variance of an individual day. So, under reasonable assumption, the following approximation is pretty darn good. The standard deviation of the rate of return on an investment with constant per time unit variance tends to grow with the square root of time. And in order to make something interesting out of that, we want to use this. If your portfolio risk is 10% per month, then what is your annual risk?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, it's got to grow with the square root of t. There's 12 months in a year, so it's going to be about 35% per year. Pretty cool. And I can annualize and unannualize, and it goes with the square root, not with linear numbers like the expected rate of return. When people try to evaluate fund managers or do performance measurement, they use something called the Sharpe ratio. It's badly flawed, but very, very common. The idea behind it is sound. What you want to do is you like things that are reward and you dislike things that are risk. So you put the reward, the expected rate of return, on the numerator and the risk on the denominator. The average rate of return grows with t. If on average you make 1% per month, over 12 months, you're likely going to make something like 12%. Not exactly, I know there's geometric compounding, but it's close enough. The denominator, the risk, grows with the square root of t. So if I told you that your standard deviation per day was about 2%, then it would grow with the square root of 12 times 2%. So we're talking about, well, maybe 8%. So the Sharpe ratio grows with the square root of time. In the real world, when people go and try and sell their funds, their hedge funds, other things, they almost always tell you the Sharpe ratio by starting off with monthly rate of returns, which they then annualize with the square root of 12. The historical Sharpe ratio of the stock market depends on the sample period, but reasonably speaking, the annualized Sharpe ratio for the S&P 500 for the stock market is about 0.5. Almost done. You've almost survived these slides. One more point. Is it easier to maintain a value-weighted or an equal-weighted portfolio?
Please pause this video now, answer the question on a piece of paper, and then continue.
Okay, it is much easier to maintain a value-weighted portfolio. For example, consider the following. You start with 2 assets that are roughly similarly sized firms. They have about $10 market capitalization, and you buy 50-50 in your portfolio. Now, one of the 2 assets is going to go up dramatically, just by pure chance. In your portfolio, if you don't do anything, your own portfolio share in that particular asset is also going to go up tremendously. So without you trading, whatever is larger in the stock market, value weighted, market capitalization weighted, is also more weighted in your own portfolio. So value weighted portfolio almost come about by themselves. And if you start with a value weighted portfolio and you want to maintain it and nothing starts, enters, exits the stock market, and there's just variation, it still stays value weighted. So that's just perfect. In contrast, an equal weighted portfolio, every time that one particular stock goes up a little, now you have more of that stock. You got to sell some of this and put it into the other stock that didn't go up that much. Much easier to hold a value weighted portfolio. If that's not clear, feel free to ask me in class. That's it for this video, for Chapter 8, and for my admittedly too brief introduction to investor choice. Hey, you're not taking an investments course here, but a corporate finance class. In the next 2 chapters, we'll change tack and ask completely different questions. So far, we've only looked at what an individual investor would want to choose. We will start looking at what economists call an equilibrium. So here's the question. How should different stocks be priced in equilibrium? If we rule out situations in which there are huge bargains, like stocks with huge expected returns and very negative market betas, or arbitrage, so stocks are reasonably priced relative to one another, then how would we expect their expected returns to be lined up with their characteristics, such as risk? See you soon. Bis bald.
My girlfriend is like the square root of 100.
And what is that?
A perfect 10.
I think you mean a minus 100?
But that does not exist. It's imaginary.
My point exactly.
Your decimal point?